Okay, we are going to look at some of the business development companies. So I want to get into what's going on in the sector, what do we need to worry about, and what we can do to protect ourselves. So the first one I want to look at is a holding that we have in our portfolio, which is F Capital. Now I'm going to just switch over here to the overview for the company on the Koifin platform. And we can see, obviously, there was a big shift here in the pandemic. Now, this is also one of the reasons why you don't want to be holding too big a weighting in BDC. So yes, they can be very high yield, and yes, it can be attractive, but it's this cataclysmic drop here from about $25 a share down to dollars a share. If you had a portfolio comprised entirely of this type of stock, then you would be in trouble. But if we zoom in to the last 5 days, we'll see this other big drop here as well. Now, this is due to the earnings call, and they've dropped down to 1864, 1865, and they've bounced up and down here several times, finding a level of support here at about $18.50, and now shooting up to about dollars per share. So the big question is, what happened here, and do we need to worry? Now, even here on the Koipin platform as well, we can see a couple of interesting differences here. So this is all on February the 20th. We've got one company switching their price target from $21 to $20. We've got one lowering it from $22.50 to $20. We've got maintenance on $20. We have JP Morgan adjusting it down to $18 and $20. We have Truist adjusting it to $20 from dollars. So we've got this general trend of adjusting down, and the price targets seem to be at about the $20 range. So we're not far off where these analysts are expecting the price targets to be. And when we look here at the dividend yield and payments, we can see that the dividend yield at the moment is quite high. Now, this is comprised of regular cash dividends, and as we can see here, on top of quarterly dividends, I noticed, for example, the other day I received the 5-cent dividend here, which sounds very little, but it is a special dividend, and it is a dividend relating to, for example, some of the liquidations and capital gains that they experience. Now, is this a steal? And this is one of the key things where I think this type of screen here, where we're looking at the percentile rank, can be quite useful. So we can see here, for example, in terms of valuation, it is more or less lighting up the board here in terms of green against its own 10-year history. So it seems to be trading at a reasonable return here. Now, some of the important ones I think for a BDC is this idea of price to book ratio, and the price to book ratio here at about 0.8 is suggesting that on average we're spending about 80 cents to buy $1 of a book value in their portfolio, which in my mind is quite a nice and quite an attractive type of valuation. So the big question is, if this looks rosy, and they do have a high dividend yield at the moment because of the depressed prices, is this dividend safe? And what is going on, and what drove this cataclysmic decrease here in prices here on the 27th of February? Many of the BDC companies in the same sector, they're birds of a feather. They're going to be moving together. They're going to be experiencing the same pain, the same suffering. So here I have F Capital. I'm on the Seeking Alpha platform here, just looking through the transcript. And now, even though I'm looking at FSK, it is a business development company, and these companies do more or less move in unison. Now, what I want to do then is I want to have a look at some concerning notes here from Ares Capital. Now, Ares Capital, I'm going to scroll down here. I'm going to pull up the transcripts. Ares Capital reported under a month ago, and so we can see here, February 7th, the Q4 earnings call. Now, I've already had a good look through here, and there's just a couple of things I want to pull out. Now, as we look here, there's a couple of important points here. So the first point here is really talking about new funding, and it's important here that they note that the all-in on new yield investments is going to come down. So the general trend is the yield on the new investments is going to be coming down in the next couple of years, simply because it's not in terms of a bad thing. This is just the natural market cycles here. Now, they've taken advantage of the higher yields in the last several years, and they have done okay. Now, the analyst is asking here as well that the last part sounds good, and they're sounding as though dividend coverage is still strong, which is fantastic. Now, the other point here made by the executive is, of course, they're not just paying the dividend, but they're obviously here using excess sort of funds to build up their net asset value, the underlying value of the overall fund that they're administering here. Now, he's also noted that this is a luxury at this point in the cycle. So he's also saying, hey, look, this is this at the end of the cycle. We're heading into a tougher time here as well. Now, perhaps the most important part here is this paragraph, and I just want to read from this. So the analyst is asking, what sort of confidence do we have that the portfolio is going to stay relatively stable? And the executive's essentially saying, hey, look, the trend's going to be lower, and we're going to see defaults pick up substantially, right? Now, this is a key point here as well, default. Here as well, we've said this in the past year that we're going to see defaults in the industry just increase a whole bit of time this year. Now, importantly here as well, it's going to take some time and it's going to be in the bottom quartile of the portfolio and probably everyone else as well. Liquidity is getting tighter, so the weaker companies that they are lending to in the bottom quartile, the weaker ones, they are going to be experiencing more stress, and that is going to put pressure on Ares Capital. Now, I'm going to come back a little bit later to explain a little bit about why I think Ares Capital in particular is going to be challenged by this. Okay, now I want to switch back to FSK Capital here. Now, again, I'm going to pull up the earnings call, and this is another fantastic feature here of the Koipin platform. I've got everything I want, everything I need here at my fingertips. Now, I've already looked through the transcript and the key elements here. Now, I just want to switch back to FS, and I want to pull up the transcripts here. So the more recent transcript, now this is February 27, end of February. This is not too long after the Ares Capital bombshell, really, about what's going on. Now, I've already read through this. I've got a couple of things I want to look at here. So I'm pulling this up from a non-accrual perspective here. So I'm just zooming into exactly what I want. From a non-accrual perspective, non-accruals represented approximately. Now, this is what I think spooked the market. This is why we saw that big drop in response to the earnings call. Basically, the companies not paying or behind on payments represented approximately nearly 9% of our portfolio on a cost basis and about 1/20th of the portfolio on a fair value basis. Wow. Okay, so that sounds quite scary. Now, that sounds also pretty much what the Ares Capital executive was talking about. We have some rough seas on the horizon here. But, now this is the important thing as well. Now, I think this headline number here is a bit concerning. But, now this is a big but. If you remember correctly, K was taken over. So the portfolio had been managed rather poorly in the past. When KKR Capital took over and KKR Credit and started to originate new underwriting performance, this has had a big impact. So as we look here, at the end of the fourth quarter, 87% of the portfolio, which had been originated since they took over and basically improved the performance of the underwriting and loan origination of most of this portfolio. This is where we see the big thing. So 87% of the portfolio accounts for 5.1% in a cost basis instead of 8.9% on the overall portfolio, and 2.6% on a fair basis as opposed to 5.5%. So essentially what we're saying is 87% of the portfolio that the new owners, that ARCC Credit has been in charge of in terms of underwriting, loan origination, due diligence, risk management, most of this portfolio represents only half of the actual problems here in terms of the non-accruals. So the non-accruals essentially mostly coming from the 13% of the portfolio, which is still a legacy or a hangover from their past. Now, what does that mean? It means that, yes, the headline here looks bad, but since KKR Credit's come along, we've seen much stronger performance, and that, my friends, I think is important. Now, the big question is, am I bearish on these companies as a whole? And the answer is no. I'm not, however, going to be originating many more positions in business development companies at this point in the cycle. I have done very well. I have written up some nice capital gains, for example, in Capital Southwest Corporation, even Main Street Capital. Now, what I want to do here is I want to come to the closed-end fund advisors. There's a link in the description below. They have a fantastic resource here where they've got a lot of data on BDCs that is not really available elsewhere. Now, yes, we see elsewhere things such as discounts and premiums and yields, dividend yields and things like that. But I want to look here at some other factors, such as where they've gone through each of these companies and they've looked at the first or second lien loan. Now, what this is essentially saying is these are the more likely to be repaid by the client organizations in case of financial stress. So if there is a serious case of non-accruals, I want to be, for example, holding a position in Goldman Sachs BDC or Black Secured Lending. Why? Because if something goes wrong with their clients, most of their loans are first or second lien, which means most of their loans have a pretty good chance of recovering some of the money to the business development company itself. If we sort by these first, second lien loans, we see, for example, Goldman Sachs, Blackstone Secured Lending, BKCC is another one here as well, Horizon Tech. And we're seeing here up in the 95 to 98% sort of range here. Sixth Street Specialty Lending, Gulab Capital as well, still in the 90% here. So these are some companies that I know a lot of investors are looking at. Blue Owl Capital Corporation 3, so a new listing, that's why it doesn't have these other data filled in here. But even this company has 89% first to second lien loans. And if we scroll down as well, we can also see Blue Owl Capital here at 82% first and second lien loans. Now, the challenge as we scroll down here is we get to the bottom of this list and we're falling out of the 80s here, and then we're hitting the 70s, and this is where FSK is sitting. So 75% of their loans are first or second lien loans. Now, again, I suspect that if we looked at who originated these loans, I suspect we'd see that most of these loans here that are first and second lien were originated by the new owner after the change of management. So more secure underwriting and better first and second lien loan percentages, and some of this loans falling outside of this proportion, some of the 25% that are higher risk, are probably those legacy loans that are already on non-accrual. Now, what that means is I think fundamentally here, I'm seeing a relatively low risk here, despite the headline number here. Now, as I scroll down, though, I'm also seeing Main Street Capital, which is another position that I hold. It's only got 2/3 of these loans are first or second lien. Now, that's a little bit concerning to me. However, I do have confidence in the management team and their track record. And I think this is where I'm very wary and cautious about Ares Capital again, because again, they've got this 2/3 first, second lien loan, and they've already warned us that the lower quarter of their portfolio is going to be coming under pressure. And so that's a challenge, I think, for this company. So if, and this is a big if, my friends, if I was going to look at business development companies, my question is, what would I do? Would I be initiating new positions? And the answer is yes, maybe. Now, a big part of this here is this market yield. What I'd be looking at doing is I'd be looking at the top of this list. I'd be looking up here for the top 10 companies here in terms of first or second lien loan. I would be looking for some good market caps. So it's got to be a larger company. I'm going to be looking at, yields is good. They're always good here. But what I really want to see is this first, second lien loan. Now, as I look down here, I can see some pretty attractive opportunities. I think a market yield here of nearly 12% with a fairly good portfolio here, and 3-year total return has been pretty good as well in terms of the price return, but also some pretty strong NAV returns as well. So I think this is certainly a good option here, where Goldman Sachs has been managing the BDs fairly well for a while. So that's definitely one option I think that would be quite an interesting one to take a closer look at. Now, of course, this is common stock that we're seeing here. Now, the other interesting thing to think about is the fact that many of these BDCs also issue notes. Now, the notes are essentially baby bonds, and let's have a quick look at some of those options now as well. So if we're worried about risk here in the common stock, what can we do? For example, many of these companies, many of these BDCs will issue baby bonds. Now I'm going to switch over here. Saratoga, for example, has first, second lien loans at about 84%, which is it's not too bad, but I'd still consider it a little bit too risky at this point in the cycle. But if I switch over, they have recently issued this here. Now these notes are yielding 8.5%. They're due in 2028. Now, one of the nice things about the baby bonds that are issued by the BDCs is they tend to be fairly near term. So here we're talking about only 4 years. So you're not taking on a huge amount of risk by doing this. Now, the BDCs are also limited in the amount that they can issue. So they're not going to be over leveraged in this sense. So I believe that these are often going to be very secure and very stable, safe, about as safe as I can find in terms of baby bonds. So if I was going to look at BDCs, I'd be looking at this type of baby bond here. Now, yes, 8.5, it is a lot lower than the actual common stock yields, but I think there's a couple of key things here. Number one, it's going to be stable. Number two, the prices are also stable. So remember what we saw with that cataclysmic drop in K during the pandemic. That is not going to be such an issue with this type of baby bond. So what exactly are we looking at here? A couple of really key points here. So we're paying quarterly. It's important to note for US investors that the 15% tax rate here is not, they're not eligible for this. And so these distributions are interest, so they're not dividends, so they are distributions. Now, also note that it wasn't rated by Moody's and S&P at the time of the IPO, but it did get a BBB plus by Egan-Jones Ratings. Having said that, I think this is a fairly nice sort of option here. Now, at the current prices, we're talking about an 8.3%, 8.4% dividend yield. So I think that's pretty good. Now, Quantum Online is also a really nice platform. It's got a lot of data available here. We can scroll down. We can find out a bit more about the company. It's also got the overall details here that we may be interested in. And so I think when we look at this, there's a lot of opportunities here. It was a good time to buy. If you could have picked it up down here at $24.87 sort of prices, I think that would have been an ideal sort of time to make an entry. But I think even here, with relatively low levels of risk, this 8.4% may make sense for some investors, particularly given the relatively stable price movements compared to, for example, what we saw with many BDCs heading into the pandemic. So, my friends, what do you think about business development companies? What do you think about the opportunities here? Are they becoming more risky? Is the common stock too risky for you? Have you looked at some of the baby bonds available here? And if you are holding common stock, what is still in your portfolio? Now, for example, I do have a long-standing position here in Main Street Capital. I like the equity positions. I like the long-term growth here that we see here in terms of this powerful NAV return. And I'm probably not going to be selling this anytime soon. Now, I do have the what I consider to be a slightly riskier position still in FSK. It's got this relatively less favorable first to second lien loan. As we saw, the non-accruals are ticking up, but I do still like this market yield, and I'll probably be keeping this position or perhaps trimming it perhaps in the future as well if I find an opportunistic time. So let me know what you think. What are you holding? What are you looking at? Let me know in the comments down below, and I'll see you in the next video.